Good afternoon, everybody. How's everyone doing? Hey, hey, hey. Happy Monday. Hope everybody had a fantastic 3-day weekend. Hope you guys all did some fun stuff. Nice. Today is Monday, April 10th. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure there. Schwab new swing. Intraday today, I traded a bunch of names I got out of. Pins, Roku, Shopify, a couple others maybe. That's the current position disclosure. Oh, Microsoft, Meta, forgot about both of them too. Okay, yeah, good day today. SPYs here closed up 0.2%. Qs are exactly flat. And the IWM is up 1.2%. So we got some more of our mean reversion that we've been looking for. IWM, Russell catching up to Qs. We got it in a big way today too. So that is really pretty solid. Yeah, great candle today. So, you know, this really, not that I need to justify our process, but this is just a perfect example of why our process is what it is in the morning, why we start from the big picture down to the small picture. Even if you're just specifically a day trader, you trade on the small time frames, understanding that big picture really sets you up from a game planning perspective, even on those smaller time frames. Because this morning was a little bit scary, right? We had a really big gap down this morning. I don't remember the exact percentages that we were down, but it was like 0.5% to 1% plus, depending on which index you were looking at. And it was pretty weak. You know, we were kind of testing Thursday's low early on in the day. But again, this is why the big picture is so important, because you want to analyze what does this mean from a technical perspective. Well, from a technical perspective, we had a common gap to the downside this morning. Common gaps, also referred to as area gaps, typically get filled because you're gapping down to an area where no one's really in trouble. Right? If you're long from, I don't know, say Thursday last week, and we have this big gap down this morning, but we're still above Thursday's high, you're not really in trouble as a long, right? The stock that you're in or the market is probably not gapping past your stop loss where you're panic selling. And in fact, you might be able to add to your positions from a better, you know, air quotes, discounted price. I mean, I know that's what I did. Right, we had a big gap down this morning, and we were above yesterday's high. Obviously, a little bit different because, you know, approaching the market as a professional. But I'm coming in and I'm buying this morning. So you get these potential buyers coming into the market, but you don't really necessarily have panic sellers. For people who want to sell short, yeah, you know, I'm sure that there was some people trying to apply their bearish thesis onto the market that we should go down, and this gap down is just the beginning, and the jobs number on Friday, blah blah blah. But there was no real technical impetus for heavy short selling because, again, you know, we're still above last week's low, we're still above Friday's low, we're still above the ADMA, we're still in a bull trend for the SPYs and the Qs. So while this morning was certainly, I thought, a little bit scary just because of the degree of the gap, and especially, you know, Apple kind of leading to the downside pre-market because it had some bad news come out that people aren't buying their computers. I can understand being a little bit fearful, but technical analysis, you know, says common gaps tend to get filled. So that means that just based on that alone, you'd rather be a buyer than a seller. Trend analysis says we're in a bullish market, at least for the SPYs and the Qs. It says you'd rather be a buyer than a seller. Our extension analysis shows us that we are no longer extended at all as of this morning after, you know, the couple days of price correction that we had on Tuesday, Wednesday last week, followed by the attempted pivot low on Thursday. And that attempted pivot low, we're still above it.
So there's just a lot of reasons to have the game plan this morning. And again, look, I was a little bit nervous. Big gap, apple, my swing positions that I'm long are against me. So of course you're going to be a little bit nervous, but you kind of just have to do what the right thing is for the market consistently. And if you bought this morning, and we ended up really breaking down, below SPY 406, getting below yesterday's low, then you stop yourself out of some of those positions, and then you reassess. You reassess as you come into, like I said in the morning meeting, we could pull back to 403.50 and still be healthy for bulls, though momentum bulls do not want to lose the positive Maribosi low from March 31st. And honestly, ideally, because we have the attempted pivot into the ADMA yesterday, they really don't want to lose yesterday or Thursday's low. So we're still above all that. So again, you take your longs off the open. If they hold, great. If they don't, thanks coffee. If they don't, then they don't. And it made for, just a really good kind of buy setup and some things. And then the other piece of information that was really important for today, which has been consistently important, was recognizing the pre-market strength in the IWM. We had that heavy sell-off pre-market that enabled the Russell to kind of catch up a little bit to the SPYs and the Qs, which made me nervous. Let's go over our pre-market charts. We could take a quick look at it. So pre-market, we're set to have this flat open-ish for the SPYs. Qs were kind of set to gap down a little bit. There's your Q relative weakness. But the IWM was set to gap up solidly. And then for the first leg of the sell-off, pre-market got back to flat. For the second leg of the sell-off, actually got back down to red, still above Thursday's low, but a little concerning that pre-market the IWM was catching up to the Qs. I know that made me a little bit nervous because we've seen on other trading days over the course of the last 1 to 2 weeks, even though we specifically are looking for and actually getting mean reversion where the IWM has been catching up to the Qs, it's not an everyday process. It's something that could take, the deviation between the Qs and the SPYs post SVB blow up just got, I feel like, more massive in such a short period of time than I've ever seen, period. I don't know if I've ever seen such a big difference in such a short period of time between those indices. The indices usually trade, at least to some degree, together, even if there's going to be strength somewhere, outperformance somewhere. They usually are trading somewhat together, not Qs going straight up and IWM going straight down. So it's a multi-week, multi-month process. It's not going to be an everyday thing. Pre-market, I was loving what I was seeing. When we sold off at 7 to 8:15 a.m. Eastern time, that also made me nervous seeing the IWM catch up. But then right off the open, look at this strength in the IWM. It was massive, and this was the big signal. You had this big strength coming into the IWM. You had your Qs, on the other hand, selling off really hard for the first 20 minutes. And the SPYs, naturally, like usual, kind of being somewhere in the middle and battling back and forth on a range. But what did that make for? One, you recognize that relative strength in the IWM. So what are we going after? We're going after banks, we're going after energy stocks. And they gave some good opening drive trades today. Bank of America, great opening move today. And I know some of us, we're buying Bank of America, JP Morgan early today. I bought some Bank of America on that dip. I bought some JP Morgan on that dip, though. I think Pat got a better price than me when he communicated that he was buying. Schwab was like the really solid one that we had on our list from the morning meeting today as a buy through 50, which I love that so many of you guys were in this. A whole bunch of us were in this together, which was great. Big consistent volume, breakout through 50, had some news this morning. Again, I added this to my swing list because it closed so well. I think that this one has the potential to work its way up to 54 to 56 on the break of this daily chart descending channel that it's been in, which it's basically testing and nearly breaking as of today's close. Energy, which I did not participate in, was giving good opening moves as well. In the beginning of the day, some people were looking at Oxy versus 63 area was something we discussed in the morning meeting. Worked out really well. Chevron I thought was a little bit tougher, so I didn't really go after that one. Apache was another one I mentioned in the morning meeting. That one traded pretty well. I didn't end up being involved in any of the XLE names, even though I thought they looked good. So that's what the IWM is initially telling you when it's showing you the relative strength. But then, and this was another weird one, right?
Look at the difference between the IWM in the beginning of the day and the Qs in the beginning of the day is extreme. You got your Russell trading straight up, and you got your Qs trading straight down, and not only were they extended from the gap, but they were becoming significantly more extended over the course of the first 20 minutes. And at lows, when we got this hammer to kind of come in at about 950, my thought process at a certain point is, so beginning of the day I'm looking at these banks, like 20 minutes later I'm trying to dip by big tech, because, and we've seen this consistently on the rotation days when the IWM is outperforming and the Qs are acting weak, and we've had a bunch of those days over the course of the last couple of weeks. The Qs don't give any real follow through to the downside when the IWM is holding up. So yeah, you got this early momentum selling. It looked like rotation out of mega cap tech into, you know, banks and energy, but you just don't end up getting the follow through when the IWM is doing this. At a certain point, at the highs of like the 950 bar here, which I think happened before the low of that bar, I actually got a little bit concerned. What were the Qs doing at that same time? Yeah, Qs were trying to pivot. So I had big downside extension on the 5-minute on the Qs for 9:50 a.m. and I had big upside extension on the IWM, and I was actually a little bit nervous because the SPYs were somewhere in the middle and they were kind of rolling over and testing lows and becoming a little bit more bearish again. And I was like, oh boy, well, here I am thinking that the Qs are going to have to pivot back up because of the strength in the IWM. What happens if I'm actually got that backwards, because the SPYs aren't looking so good right now? They're retesting this 406, which is kind of that opening low, for a second time with my IWM extended the upside. What happens if the SPYs break down and the IWM gives a bigger pullback? Then these Qs might be completely shot. So I was a little bit nervous for a couple of minutes there, but the same thing played out. That IWM relative strength means that the Qs don't necessarily have to be strong. They didn't necessarily have to even fill the gap and close flat like they did. It just tends to mean that it's going to be a struggle for them to give real downside follow through. So again, initially, you know, looking at some of these IWM banks, energy stocks, to give those initial bounces because we're seeing the relative strength. But then the secondary trade was, well, look at this big downside extension in the Qs, right? There's got to be a trade there. And there was a whole bunch. And for the most part, a couple of them were a little bit tricky, but it worked out really well. Apple was the one that I bought heaviest, even though it was weakest. 162 is a level. It lost that with the news. But 160 was also important. 160 was important back here in the kind of the second half of March. I remember this acting as resistance where it was really struggling consistently to get above that 160. Now you're super extended, albeit with bad news, into that 160. Apple, as we know, is a stock that tends to respect its levels, which is interesting because I feel like not many stocks do that anymore. Like it's become such a, the failed breakout and failed breakdown and kind of taking the other side of the trade has become like almost like a pretty consistent trade. Like most stocks and these ETFs and the S&P, they really tend to not like respect their levels in the way that they, you know, air quotes should. They kind of break through them and snap the other direction all the time. Apple is one name that really tends to respect its levels. And I remember looking at Apple approaching 160 and saying that out loud. Well, Apple is a stock that tends to respect its levels. So maybe we could look for, and this has been a trade that I've been doing at certain times with some success when I can combine it with other layers of probability. I started looking at like that 5-minute chart RDR that I've been talking about a lot lately. You know, it's coming down to a really important daily level. It's very extended to the upside. 3 big red bars in a row. On bar 4 here, if it can break the previous bar's low, if it can break bar 3 low and then come back through, I can buy versus that low, and that's pretty much what I was doing. So 160.22 was that low. I think I bought 160.22 on the way up, and I was like, you could use the low as your stop, you could use 160 as your stop. I actually was keeping it really tight. So what I did here was I bought like a good amount of stock, like a much larger tier size than I typically buy, but I kept it really tight. Buying like approximately $160.22 with a stop loss a penny below that low, so 160.07. Initial snapback was kind of disappointing.
I thought I would kind of easily get a touch of 161 off that, and I didn't. High there was 160.67, and then 160.73. I remember being annoyed because I had an offer at 160.74. I mean, no matter what, I had my risk covered. My risk was covered on that buy by the time it got to 160.50, plus some actually. And then eventually, when the market broke up, Apple was able to break up a little bit as well, and that turned into a pretty good trade, despite the fact that at the end of the day here, the Qs are flat and Apple is down 1.5%, so it really shows you the relative weakness. But we were buying Apple there. I was buying Microsoft into this 285 area. That was just like a quick mean reversion trade for me, where I was just looking for a quick snapback to the 80 MA and liquidated the entire position. I did pretty much the exact same thing with Meta at about buying at about 211, just looking for some mean reversion into like the 80 MA. I got out around 212 on that one. So same thought process there. Google was the worst one, which is interesting because it's been the strongest on the daily. Google off 106 was the worst one. It didn't really work. Amazon in $100 area again did almost the exact same thing it did on Friday, where it kind of shook out the level. Remember, I was just talking about how most stocks and most ETFs don't hold their levels clean anymore. Apple seems like it's one of the few that typically does. This Amazon 100's been important. On Friday, this was a trade that we had, and it snapped through it on big volume by 20 cents, and that was the low, and it came right back up. Today, it broke 100 again and broke that low to like double shake people out, and then showed some strength and gave that snap back. So Amazon was another one that I bought like right into this $100 area and managed to be able to hold through for that trade. And I was doing the same. Shopify I got back into earlier today, kind of bought that dip a little bit, worked out pretty well. Pinterest, I small bought the dip in Pinterest today, liquidated that on the snapback into 20 bucks. Roku, I got a little lucky with this first fill. This low right here is $62. I bought $62.01, so I got a little bit lucky on that. That trade worked out. Rebought the $62 area here, just real light. That's a continuation trade of a previous one that I was in that worked. So just like everything worked really well except for probably that Google into that 106 zone. But it all, just to circle back to kind of what I'm hinging this meeting on, it all circles back to the big picture. It all circles back to that big picture thought process, and that big picture thought process is coming from that daily chart. We're studying the gap every morning. We're studying the daily chart technicals. We're trying to figure out where we can expect relative strength and relative weakness to come in. We're recognizing that strength in the IWM can mean that it's much more difficult for these Qs to really break down independently unless the IWM rolls over as well. And you put all those pieces of information together, and then all of a sudden today becomes kind of a relatively easy buy the gap down, buy the dip kind of trade, where I mean all this stuff may be really good intraday money. So I hope you guys are able to perform well with it as well, and I think that's all I got. So happy to answer any questions that you guys have. Let me start by scrolling up here into the VTF, see if I missed anything. Thanks again to More Coffee for giving us the YouTube link and reminding everyone that they should press that thumbs up button. Greg P. in Microsoft today. Microsoft with a nice little inside day. Yeah, this one was also trickier because it was like the strongest ones early on in the day were the weakest off the open. Meta and Microsoft so strong on the daily chart from Thursday's session, and they were like the heaviest selling ones in the beginning of the day, but they just reached a level of extension in combination with a retracement of the previous day's move that made that buying kind of a good spot. So average price of $285.52 and rode it all day, trim and trail. I love it. Great stuff, Greg. Kyle on Oxy. With Oxy this morning, would buying through pre-market high versus lows a valid way to get long? A lot of times the answer to that's going to be no. It really depends on if there was any volume pre-market. And there's not really much volume going on here pre-market, so I don't love the idea of buying through like 63.50, which is kind of that pre-market high, and using that as an entry. I only like utilizing the pre-market technicals if what I'm looking at was really moving and trading really liquid. So we're coming into earnings season soon, and it'll be important to pay attention to the technical levels that are created when some stocks like Apple and Google and Amazon that are all going to trade really heavy after hours off of their reports like they always do. The levels that they create after hours on those days will be particularly important. Usually, to some degree, index levels from pre-market can have a degree of importance because they trade liquid enough. But if you look at like that Oxy that's just full of gaps and trading 100 shares here, 100 shares there, then I really wouldn't do it. I didn't have Oxy on my screen off the open, so I didn't really watch it. I mean, the trade really would have been just to get stock for 60. Sorry, excuse me, I'm choking. would be just to get stock first at 63, which is a very clear, obvious, previous resistance becomes future support kind of level into the 80 MA. It was a little bit scary when your previous bars will close on lows. I usually don't like to buy versus a low that was, stock that closed on lows as that low. In this case, usually I prefer, and even in this case, I usually prefer like looking for an RDR where I'm buying back through when you get a close on lows and buying back through that day's low and not chasing like a gap up. It's interesting that Oxy was able to gap up, and I think XLE was able to gap up when the entire market gapped down this morning. So really interesting to see that, and maybe you could look at just the clear importance of 63 and combine it with the fact that it's got enough relative strength to actually gap up when everything's gapping down, where you could just be buying some stock off the open versus 63. But I would point out that generally you got a stock that closes on lows and gaps up the next day, it's usually not a good idea to actually be buying versus that low. So the Oxy entry might have been a little bit tricky. I can understand wanting to be patient, wanting it to break the previous day's low and come back up. But again, 63 just a very, very clear level, and obviously showing a lot of relative strength because the entire market was gapping down really big this morning. So I think that would be the only way to actually get stock in this. Is either you bought it right away versus 63, or if you're a little bit late but you saw the opening kind of insane momentum that was coming into these energy stocks, then you can buy maybe versus that opening low, recognizing that the fact that it's above 63 is just like an added kind of layer of probability in your favor. I think those are the only two ways you could have gotten stock in this off the open. From Toussaint, what size should you use on bank stocks? For example, BAC has an ATR of 88 cents, so should I size between 500 and 1,000 shares? Schwab has an ATR of around 3. Should I size between 300 and 500 shares? So I don't ever look at ATR. I really don't like it as a statistic. Sure, I want to know that my stock has the ability to move. That is important to me. But I don't like looking at ATR because, as a general rule, if I'm doing a good job, and this is definitely a general statement, as a general rule, I want to be focusing on stocks that day would be trading with higher volatility, higher volume, and a higher range than it typically does, as a very general rule. So I don't like looking at ATR because if Bank of America has an average true range of 88 cents, and that's a number that goes back for 3 months, you have to keep in mind that's an average, right? So some days the stock maybe moves 45 cents, and other days the stock moves $1.50. I want to be trading it. I want to be focused on trading it on the day when it's moving $1.50 or $2, even if the ATR is 88 cents. And if it's in play, or if it's having a technically important situation that's occurring, that's when you get the outlier days. So I find that ATR is a very misleading number to look at if you're doing a good job, and it can be reward limiting. People don't usually bring up ATR questions in the way that you're actually describing yours, so I'll get into that also. Usually when people ask me about ATR, it's about profit taking. Like, hey, I'm in Schwab. Schwab is an ATR of $3. I just caught a $2.50 move. I should probably get out of my entire position, right? And I always say no, because I want to be trading Schwab the day that it's moving $5, the day it's moving $6, and then when it closes well, I want to swing it so I can get today's $5 and tomorrow's $3. So that would be the first thing I would say about ATR. The second thing I would say is that it's also not the right way to judge tier size. You should judge tier size. Tier size is the amount of stock that you take is the last part of the formula.
the formula for risk is space risk times size equals total risk, right? Space risk, it's the difference between your entry point and your stop loss. Your entry, we call it an out. It's the difference between your entry point and your out, right? So my space risk, I'm buying at $25. My stop loss is at $24.80. I've got 20 cents of space risk. Tier size, you know, if I'm taking 1,000 shares at 20 cents risk, it's $200. And again, total risk. That's the last part. $200. I already gave away. So it's space risk times tier size equals total risk. But the tier size actually should be the last part of the equation. What you should know is, based on my account size, and again, you're saying, you know, you're a rookie, but you could have a $10,000 account, you could have a $100,000 account, you could have a $1 million account. We got people in the room with massive variety of account sizes. So based on what is appropriate to your account size, the question never is like, and I find a lot of traders make this mistake. They say, hey, I'm a new trader, so I'm only trading with 100 shares, or I'm taking everything with 200 shares. The tier size isn't what matters, it's the dollar risk that matters. I could take 100 shares and risk $5,000 in it. or I could take 1,000 shares and I could risk $100 in it. It's all about how much space I'm giving it, right? So the first question is, the trade that is in front of me, question number one, the trade that is in front of me, how many dollars of risk is this trade worth to me based on my account? And I always like to use small numbers when I make up these examples, and if you're with a big account or you're a more experienced trader, then you can just add multiples onto it, right? So how many dollars is this trade worth to me? It's worth $100 of risk. Okay, cool. What's the appropriate space that I would have to give it in order to be able to get in? All right, well, I'm buying $25. The stop loss would have to be at $24.80 in order for me to trade it right. That's the low of the ignition bar, or that's the low of the pivot, or you know, whatever this, because every specific trade also has a specific stop loss that comes with it, right? So in our example, it's $25 versus $24.80, and you already know how many dollars you want to risk. So now you know how many shares you're taking, and that's it. You decided I want to take $100 in risk. The trade is telling you it's 20 cents worth of risk. You buy 500 shares. It has nothing to do with what the ATR is or anything else. And that is really the right way to approach it. And if the stock is, I mean, we do still need to pay attention to space risk. There's such thing as too much space risk. And maybe this has a little bit to do with ATR, but I still don't look at ATR where, you know, I'm just looking at this thing and I'm judging. Like, if I'm looking at a, you know, and this happens sometimes, and it was almost a problem with Schwab, actually. It was like almost too much risk. $50 stock, 50 cents risk. I was very tentative in getting in at $50 on this thing. So I don't like the idea of risking 50 cents in a $50 stock. Like, is this thing going to move well enough that it can pay me? But I'm looking at the daily chart, and I'm like, oh, well, you know, if this thing's able to really break up, I think this thing could get to 54, 56 bucks. So now all of a sudden 50 cents worth of risk is potentially worth it. But I also got to ask myself, you know, again, how many dollars do I really want to risk on that? So a lot of times what I do when I have to pay up more than I want, either I don't take it at all because it just, the risk reward doesn't make sense, the risk is too much, I can't have enough tier size to make it worth it, so I don't take it all, or that's fine. Or I take it small initially and I look to add. That's kind of what I did here. I took it small initially, and then at like $50 or $50.02, something like that, I think I upticked my initial entry. And I think I bought more at $49.96 and more at $49.91. I think I had another bid at 86 too, but I don't think it got filled. Let me see. I bought more at $49.90 also. So I mean that's kind of what you got to judge, and this was almost too much risk, and because every 100 shares I take is going to be $50 worth of risk. So if this trade is worth $100 to you, to go back to that same example, you can really only take 200 shares in it. That's pretty small.
I prefer, when possible, and it's not always possible, to have more tier size and smaller risk. But I'm going to put a big asterisk around that last statement that I just said, because a mistake that I've made in the past that I don't really make anymore is utilizing stop losses that are too tight. I want to know if I'm getting stopped out that my trade idea was wrong. If I'm getting stopped out because I used a stop that was possibly too tight and there's a higher probability that I'm getting shaken out, that doesn't do me any favors. So I really want to make sure that I'm using the correct stop loss. But everything else held equal, I always prefer to be able to take more stock and have, smaller space risk. Now, as a general rule, as volatility increases, as volatility in the market increases, as a general rule, there are less opportunities with small space risk, and you tend to have to give more space risk and less tier size. That can be difficult for newer traders with smaller accounts. But there's always trades out there. I mean, like Apple. Apple today was about 15 cents worth of risk off that low. You could be. I don't. If you're working with the smallest account size that there is, you should be able to risk $100 in a trade. Like if you can't afford $100 of risk in a trade, then I don't know. You got to figure something out, because you're probably not going to be able to be successful. You're never going to be able to take enough risk or have enough size to be able to trade things properly from a game planning perspective. But even this simple Apple trade, you could be any level of a trader, any account size, and could have had at least 700 shares in this thing. Let's just call it 800 shares. I prefer to trade even numbers. I find them to be easier to game plan, because I can sell 50% at 1-to-1 and have my risk covered. If I buy 700 shares, it's like, well, do I sell the 300 shares of 1-to-1, in which case I could still have a small loser? Do I sell the 400 shares of 1-to-1, in which case I'll have a small winner no matter what, but I won't have enough stock for a bigger move? So I really prefer, when possible, to trade with even amounts, so like 800 shares. So you take 800 shares in Apple today, you risk $110 or whatever that turns out to be. You get your risk covered, really quickly. You sell 400 shares, and then you sit on that other 400 shares. You piece out. It's a counter trend trade. So counter trend trades, you want to be a little bit less greedy. So you piece out of a bunch of it on the way up, but you also recognize that on the big picture it's with the trend and it's a really strong stock. So you probably don't get out of all of it. And then at the end of the day, you're like, oh, wow, this is a counter trend trade. I took 800 shares, got 100, I got 200 left, whatever. $2 in the money. So if you got 200 shares left, then you're up $400 just on those 200 shares alone, let alone everything else that you already booked on the way up. And you say, all right, these last 200 shares, I'm going to swing it, because I've got a $2 profit cushion. I'm going to continue to use today's low as my stop loss on it. And if this great looking daily chart in the NASDAQ and this great looking daily chart in Apple are able to continue, Apple could work its way back up. It's got resistance at the upper 170s and 180. This buy, this is what I talk about all the time. This is where the big money comes from. Recognizing the importance of this area here on this daily chart, and then if this becomes a pivot low, it can be very, very possible for you to have bought 800 shares for $110 risk versus lows here, 15 cents worth of risk. At the end of the day, you're up. Again, you risked $110 on it. At the end of the day, you're up $400 in open P&L, and I don't know what it would be on the closed P&L. Let's call it another, $300, $400. Let's call it $400. You're up $800 on the trade at the end of the day. You're keeping $200 overnight. You can potentially give that $400 back, but is it worth it? I say absolutely yes. This is where I make my big money personally as a trader. Is when I capture that move, it closes at 162, and over time, I caught this pivot low on the daily chart, and I'm looking at a stock that's up at 175, 180, and I still have my 200 shares. And now all of a sudden that stock's at 175, let's just call it, and you just call it, you know, $15 on a $160 stock here on your 200 shares, and you know, you're starting to be up some real money. You know, you're all of a sudden having a trade where you came in and you risked $100, and you know you make $5,000 on your trade. That's what we should all be looking for, right? But again, it all comes down to the basics, right? These are the things that traders want to really nail into their head: how to manage risk, how to tier size properly, how to execute properly. That's the hardest part in a lot of ways, is how to execute properly, where you're combining that big picture with that small picture. And again, not every day is created equal. There are days that provide a lot of opportunity. There are days that provide much less opportunity. There are days that are in between. There are days when we think that there's not going to be a lot of opportunity, and then there is. I almost would characterize that as today. It was like coming in today, I was like, all right, well, I think we got to do a little bit of dip buying because it's what the technicals say to do. And then at the end of the day, it's like, oh, hello, I got Schwab a couple bucks in the money. I got Apple a couple bucks in the money. And again, you hold those things, you get bigger moves, and then all of a sudden, you know, it makes your month, it makes your quarter, it makes your year, right? So, appreciate the question. From Anthony on Amazon. Sorry, I just got distracted by something. From Anthony on Amazon. Entered Amazon at $9.39 at $99.91 versus $99.56. Love it. You cheated on the entry, but I called it out. I called it out. You know, someone, it might have been you, asked me when this thing was below $100, hey, do you think buying it back through $100 is a good trade? And I said, yeah, I kind of like the idea. And then I remember watching this thing and seeing it at like $99.80 and saying like, ooh, it's tailing up. You might be able to get a jump start cheat on it versus this low. And I think a couple people did that, apparently including you. So awesome, you covered your risk. After the new high of the day was set on the 15-minute 11 a.m. bar. Okay, I can just tell based on the 5-minute. 101.30, I moved my stop to 147. A penny below the previous low on the 15. Don't like that trail. Don't like that trail at all. Let me read the rest of your question. The trailing rules were met on a 15-minute chart. No, they weren't. This isn't a pivot. It's just a bar low. I really don't like trailing bar to bar. I like trailing based on pivots. The trailing rules were met on the 15-minute, but when I looked at the 5-minute chart, I felt like my trailing rules put me at the 1040 bar low. Right. Yeah, the 1040 bar low I can live with here. What's that low? 122? What's the 15-minute that you're using there? Yeah, I don't like this. This bar, this is not a pivot. It's just a continuation of the previous bar. If you looked at a 30-minute chart, which I don't have access to, these two bars would just be one big bar. Like there'd be no tail, right? It's just straight continuation. I want actual pivots. So this one that you're mentioning, it's still not perfect, to be honest. Really, this is the last pivot at 10:25. But this is where the pattern breaks out of this kind of 5-minute wedge. You got a little bit of a tail here. The volume begins to accelerate. I can live with this low at 10:22 on the 5-minute chart. I really don't like the 10:45 15-minute bar low as a stop loss. When the mini sell-off happened at 11:45 through 12:05, I tried to get a little more space on my stop and moved it a couple of pennies below VWAP. Is another thing I really don't like. And wasn't willing to give up more since all the indices were moving up in the same pattern. VIXY was heading up. I got stopped out at 145 at the bottom of the tail. I immediately second-guessed my trailing strategy, knowing the 5 and the 15 had different stops. I thought about re-entering versus the new pivot at that point, but I didn't have enough conviction. It's the first thing I've been really happy that you said. Amazon obviously went to higher grounds from there, and I've been kicking myself for not maximizing my reward. How would you have trailed it? Would you have re-entered where I in this situation got stopped out? Yeah, so kind of already explained why I really don't like the stop loss that you chose based on the 15-minute chart. I really, even more than that, even as I disagree with the fact that you use it as a stop loss, when you decided to use it as a stop loss, you should have left it there. I do not like this game of, oh, let me give it a couple more pennies. Instead of using the low of the pivot, I'll use the low of the VWAP. Ooh, looks like the VWAP might break, so instead of using the low of the VWAP, how about I use the low of the 21 EMA? You know what? I think it's going to break. Instead of using the low of the 21 EMA, I'm going to use the low of the day. Instead of the low of the day, I'm going to use the low of last week. You know, there's no longer any game plan going on at all. It's a very slippery slope. So I'm a big believer in, you created a game plan for yourself. You chose to put the stop in. And we can look back in hindsight on why I disagree with that stop. And maybe, you can do a better job with your stop loss going forward. But I don't think that you, change the game plan mid-moment like that. That's actually the thing I would probably dislike most out of everything that you said here. And then I like the fact that you didn't fight it, you didn't get back in, you had a game plan, you trailed, you got stopped out, it's it, you're done. But my biggest piece of feedback is that this is not meeting my rules for stop loss. There's no pivot there. From Rex, I got stopped on Google swing from Thursday at the low of the first 15-minute chart. Okay, it's unfortunate, it happens. It seemed like for whatever reason the strongest stocks on Thursday, Google, Microsoft, Meta were like the weakest off the open today, and Google stayed weak. Microsoft and Meta eventually gave bounces. Jackie on Oxy. I took Oxy off the open. Sorry, it was Kyle that was asking about Oxy earlier. I took Oxy off the open versus 63. Okay, great. And it was a good opening drive trade for me. I really liked the relative strength that I was seeing in the XLE and the other oil names early on today, and tried to be greedy with the remainder of my position. I wanted to trail on the 15-minute chart, but I also didn't want to give my position back down to lows, thinking that the stock shouldn't be able to get down there if it was going to be strong today. So I raised my stop to the low of the 935 candle. Okay, I can live with it. Which was below the 15-minute ADMA at the time. Oxy seemed to flip from relatively strong to weak at 10 a.m. as it was not getting bid up at the market. I was wondering if there are some early red flags to take note of which could suggest that a stock may be flipping from relatively strong to relatively weak. Also, do you think I should have kept my out at the day low? Or would I have also raised my stop? Yeah, so what I'm going to say is, I think this is actually really important, maybe, shoot, I just totally lost my train of thought. I remember. Maybe there are some red flags, as you call it, that could tell you that the stock could go relatively weak, from relatively strong to relatively weak. If that is true, I think you should ignore them. This just goes back to trading psychology. It's way too easy for us to get in our heads based on what we think we see and then totally change up our game plan. And most of the time when we do that, it hurts us. So maybe there was stuff out there, and I'm not even going to attempt to find it, that signaled that all of a sudden energy was going to weaken out and tech was going to catch up or whatever it is. It doesn't matter. You should already have your game plan for the trade. You can't predict that that's going to happen when you're entering the trade. Your trade's working out for you. Just follow the game plan, because maybe once in a while that'll happen where you'll recognize that and save yourself a few bucks. There's going to be plenty of other times when you get yourself out of a really good trade that just continues because you thought you saw something. So I don't think you change your stop. Whether or not this is a good stop really depends on how tight you want it to be on it, how much you feel like you need the money. So I don't have an answer for you on if I would have raised my stop also if I was in the trade. I may have.
It really depends on how defensive, how aggressive I want to be, how comfortable I am giving back more money to potentially make more versus I want to keep this tight. This is just going to be a day trade for me no matter what, or whatever. So I think that's kind of a question that's more based on your overall portfolio and other layers of probability, like the daily chart, which I do like the daily chart on these energy stocks. So the daily chart would probably have me be more greedy on how I'm trailing, not less greedy. Meaning giving more room, giving back more profit. The only way you could have had Oxy all day today is if you get your stop at the low, but we don't want to just look at hindsight and say that means that's the right stop. It just depends on how tight you want to keep it. You want to protect some money here, fine. You protected some money. You don't want to protect that money, then fine. Be greedy. Look for the big picture. Yes, SIVBQ, I forgot to mention that, is off of my positions. I just couldn't look at it anymore. I really wanted to try to wait to see if I could get a little bit of a pop to try to put $5,000 to $10,000 back in my pocket. But weeks are going by, nothing is happening, and I was really getting sick of looking at it on my light speed every morning. So I on Thursday afternoon, coming into the long weekend, I called the trade support team, who contacted the clearing firm and had them liquidate my position so that I could get pennies on the dollar for the amount that I lost. Jordan would like to know what an RDR is. Sure. So RDR, an RDR is a DOO, which is an 80-20, which I just told you absolutely nothing. RDR stands for Red Dog Reversal. And Jordan is new here to the team. Jordan is just getting started with T3, so everybody welcome to the team. We got this guy. His name is Scott Rudler. He's a really nice guy. He named a trade after himself at some point years back, which people just generally know it as a Red Dog Reversal now, which again that we just called RDR for short. Really was already a trade that existed. It was called an 80-20 trade that he kind of rebranded himself. So then you might also see sometimes people in the VTF reference a DOO. That was when people decided here in the virtual trading floor, which I really appreciate that you guys did this. I think it's kind of funny, where we rebranded the DOO, the RDR to a DOO, the Derrick Oldensmith overthrow. So any of those things are the same thing would be the first thing that I would say. What it actually is a way to catch like an oversold bounce or a way to catch a short on an overbought stock. And basically it's really supposed to be based off the daily chart. I don't know if I got any good examples on a daily chart right now. Maybe this day was, I feel like I remember this one back in December for Apple for a snapback. So what it is if you've got a minimum of 2 really big sell candles, and again typically is from a daily chart, two really weak days in a row at a minimum. It could be 3 really weak days in a row, it could be 4. In theory, actually, the more the better. What do really big down days do? Especially if you've got multiple really big down days in a row. What is that going to do to the stock? It's going to make it extended from equilibrium. Okay? Equilibrium we define as the space between the 8 and 21 EMA. Stocks that get extended eventually need to correct. A stock that is extended can always become more extended. For example, this stock was extended after this day, then it was more extended after this day, then it was more extended after this day. Just looking at Apple right now, right? So a stock that's extended does not necessarily have to go up. So you never just buy something or short something because it's moved far away from the 8 EMA. There are degrees of extension. But eventually that can't last forever. Stocks can't become more and more and more extended every day forever. But it can do it for longer than your than your account can probably stay above 0 for. If you're the wrong way on the trade. So risk management is always key. But eventually they need to correct through time or price. This RDR trade is looking for price correction.
And the trade basically is when you've got already at least 2, if not 3, or maybe even 4 big down days in a row. Like in this example, 3 big down days in a row. Day 4, you need the stock to trade below day 3's low and then trade back through that low. And you go long through that previous day's low. So in Apple that I'm looking at here, that low is 130, 132. Versus, meaning your stop loss, is at that day's low, which in this case was 129.89. And then you're basically looking for a snapback to equilibrium. And that's exactly what we got here with Apple. And you need to make sure the risk is appropriate. Buying 130, 132 versus 129.89, you're taking on, a dollar, what did I just say that low was? $1.40 in risk. You got to make sure that's appropriate with the potential reward. That snap back to the ADMA, which actually worked out perfectly. Brought the stock back up to 136.81. So that's what you're looking for. So that's kind of what the RDR is. You could do the exact same thing on the opposite. I've always liked the idea, again, we start with the big picture. We look at our daily charts and we break it down in the small picture. I've always liked the idea of predicting the RDR before it happens. And I think I did that on this day in December, if I remember correctly, where instead of waiting to buy 130, 132, I'm looking for a small time frame signal to get long with an understanding of the fact that if the stock could trade back through 130, 132 after I'm already long from a smaller time frame with smaller risk and therefore better reward, I can then potentially get the daily chart RDR reward out of it. Which goes back to exactly what I was just talking about looking for small time frame risk for big time frame reward on today's Apple trade. So that's what that actually is. SPY was a good example last Tuesday. It was Tuesday, Thursday, Wednesday, Tuesday. To the downside. Yes, and we did that trade. That's right. Thanks for reminding me, Baba. We had the 4 big up days in a row, right? 4 big up days in a row. Market was very extended, right? We also know that the $10 extension zone is where things get really extended. So we had highs there at 412, EDMAs at 404, so we were $8 extended, but it was also coming from even further prices down. Yeah, and then you could short back through that previous day's high versus the day's high, basically. So it's the same thing. So that's kind of what it is in the daily chart. Then I used to try to find the small time frame signal where the daily chart would come intact. And now a more recent thing that I've never really done before that I've been trying to do, and I mentioned it for Amazon today, is occasionally when other things line up, and you got to be careful with this, occasionally when other things line up, was it on Amazon? I forget which stock we were already looking at. I like to do it on like a 5-minute chart. I guess it was Apple. Yeah, it was Apple. That was a trade in Apple. 160 is important daily support. 3 really big red bars in a row. Super extended on this 5-minute chart. Also coming to an important spot on the daily chart. So I did like a 5-minute RDR trade where I'm buying back through 160.22 versus the low of that 5-minute bar at that time. So I hope that helps, Jordan. From Jacko, stop that at Apple at 12.03. You could have raised your stop to this low at 11.25 if that's what you're about to tell me. EDMA could open the 5-minute, new pivot high and low came in on the 5. Should have just re-entered in the next. So you got stopped out at 12.03. I hope that's the break. Yeah, so that should be the break of this low. So I'm assuming that your stop was at the 11.25 low. Any advice for not getting stopped out of a good trade like that in the first place? I think that this stop is very appropriate, would be the first thing that I would say. This really meets all of our rules. The other thing I would remind you is that 5-minute uptrends in the market very rarely last. So if you're going to only trail everything on a 5-minute chart, it's a very high probability that you will get stopped out. And this goes back to when I was answering somebody else's question. I already forget the name we were looking at, and I forget who asked it, about time. Your time frames for your stops, right? Generally, more space risk is going to be, like if you trail on a 15-minute chart, I'm mumbling all my words. Let me restart. Let me get a do-over. If you trail on a larger time frame, you are going to risk giving back more to make back more. I think that was the Oxy example we were looking at, right? If you never raised your stop on a 5-minute chart in Oxy, it never met the rules anywhere else except for off this low, you would be willing to give it back more. You know, here you're locking in some profit. You'd be willing to give back more, but you have a higher probability that what happened would happen. You might give back even more, but you might still have the stock when otherwise you would have gotten stopped out. You know, Apple maybe was the same thing. If you trailed on a 15-minute chart properly, not hurling any shade at anybody, but if you trailed on a 15-minute chart more properly, maybe use the low of like this bar or this bar for that 15-minute trail, then you never get stopped out either, but you certainly risk back giving a lot more. And for this trade in particular, it's a counter trend trade. So that means there's even higher probability that you giving it more space and being willing to give it back more just means that you actually give it back more. So I love the 5-minute chart trail for Apple, unless you're really thinking about the big picture. Unless you're really thinking about this daily chart. And this daily chart here, you're like, ooh, 160 is really important, 21 EMA, if I can get a daily chart pivot, I can get that move up to 175, smaller, probability. But unless you're really looking for that daily chart pivot, in which case you want to be giving it a lot of space and probably be willing to give some stock back all the way to this low. I never trailed Apple today. I'm just going ahead and tell you guys that. I didn't raise my stop a single time. I pieced out on the way up of probably 75% of the position, maybe 80% of the position. I just increment of like my bigger buy here. I just incrementally pieced out of it on the way up because it was a counter trend trade. But with what I had, I never raised the stop a single time because I recognized the daily chart. So that was how I approached it from a game planning perspective. I was like, what I'm going to do here is I'm going to more readily just take stock off on the way up because it's a counter trend trade on the small time frame. But look where this thing is on the big picture chart. I'm not going to raise my stop at all on some of it. I'll give some all the way back, and if I get stopped out, I get stopped out because of that where that daily chart is so important. That's kind of how I game plan that one. Cool. I think I covered all that. Someone can help. Someone on the YouTube wants me to help them with tomorrow's opening on the Nifty index from India. I can't, and not in my skill set. What's the ETF? INDY? This is the India ETF? It is. Looks okay. It's testing this descending channel here. It's trying to get above it. Would love a higher low retest of that with the 80 EMA there. I think that this INDY ETF looks decent. But I can't tell you where India is going to open tomorrow. I got no idea. Are there some tips for trading psychology? Trading psychology is a very, very broad topic. I have a class on it that you could get your hands on. That's not what he's asking? Okay. If you want to fill me in on what he's asking. Help me guess tomorrow opening in Nifty index from India. Anyway, over to trading psychology. I would just get your hands on some books. The Trading Psychology book by Brett Steenbarger is a good one. Trading in the Zone by Mark Douglas is a good one. I'd start there. Okay, all right. I am going to wrap things up then at that point. Good afternoon meeting. I think today was a great day. I really do. You know, the market did exactly what it should do based on the technicals. The gap down this morning gave us an opportunity. We had an opportunity to recognize and buy relative strength. Then we actually had an opportunity to dip by relative weakness, and they both worked out. So I think that that's awesome.
So I hope everybody was able to kind of capture some of those moves. I hope some of you guys even have some swings here into the close, and then we'll see if we can actually get some follow through on this daily chart, because this daily chart for the spies and Qs look really productive, and the IWM gave the inside and up that we're looking for that can potentially create the higher low on this daily chart that we need. But it's got to clear 176, 178, and 180 on the way up, which are all resistance levels. So that's all she wrote. Have a great night, everybody. See you tomorrow.